Welcome to the Propertybuyer Podcast, where we explore the world of residential and commercial real estate to help you make better decisions about buying, selling, or investing in all types of property. Join me, Rich Harvey, CEO of Propertybuyer.com.au and multi-award-winning buyer's advocate. Our podcast features expert interviews, market trends and insights, and practical tips for navigating the complex world of Australian real estate. Whether you're a home buyer, a seasoned property investor, commercial buyer, developer, or simply curious about the property market, our podcast is for you. Join us as we share our knowledge, strategies, and experience and help you achieve your property goals. Well, welcome again to another edition of the Propertybuyer Podcast. Today, I'm joined by Tim Lawless, Executive Research Director at Cotality, formerly CoreLogic, and one of Australia's most respected housing market analysts. Now, Tim has decades of experience interpreting property trends, economic drivers, and consumer behaviour, and his insights are regularly sought by policymakers, investors, and the media. Tim has a sharp eye for the data and an ability to cut through the noise. He helps understand what's really shaping the Australian property market, both now and into the future. So welcome, Tim.
Many thanks, Rich. That's a very generous introduction of you for me. Thank you.
You've been doing it for so many years, and I love watching you on the media and all your thoughts, and I always tap into it, so thank you. Tim, we have a little tradition on our podcast where we start with a thought of the day. So I'm going to throw an interesting quote to you. It's by Ayn Rand, who says, "The question isn't who's going to let me, it's who's going to stop me." What do you take from that quote?
Yeah, I like it. It's a bit like act now and ask for forgiveness later. It's which I think certainly applies to a lot of things we do. It's I think executing and just getting it done is a really important part of success. So yeah, I think it's a great quote.
Awesome, love it. I think a lot of people are afraid to get going. I take from that some people are going, oh, what are people going to think about me if I do this or do that? And often our own internal fears hold us back. And I think the person who's going, you know what? I'm just going to go for this because I've got a passion. Good on you. Let's do it. So, yeah. Awesome. Well, look, let's get into it. I'm going to call today's topic, Tim, cracking the code on property supply. So there's a lot of talk about the housing market, about the housing crisis, but we'll unpack that. But I want to start firstly just talking about listings. And I think I've asked you this question many times, but we seem to, I guess we want to find out why listings continue to track below the 5-year average, even when we see prices rise. Is there something structurally changing in seller behaviour? And I guess what's causing this sort of lack of listings, if you like?
It's actually extraordinary. And just to give you a bit of context, Rich, we're currently tracking about 120,400 listings across the national market. That's houses and units, so it doesn't include land or anything like that. So, and that's about 20% below the 5-year average. But beyond that, it's actually tracking around record lows for this time of the year. There's always a bit of seasonality in listing numbers that tend to pick up through spring and they're a bit lower through winter. But yeah, for this time of the year, listing numbers are pretty much at record lows. We saw something similar through the pandemic as well around these levels. But I think it really reflects a couple of things, like confidence. Even though we've seen confidence pick up a little bit, we're still seeing confidence in pessimistic territory. So that's part of it. I think there's also simply the fact when you have really low levels of listings, like what we're seeing at the moment, against this backdrop of generally stretched affordability, a lot of buyers go through this psychological dilemma of, you know, if I sell my property now, am I going to be able to buy something on the other side? So it's almost like a paradigm shift.
It is. It's a Mexican standoff.
That's exactly right. That's so true. And I think that's probably a big part of why we're seeing listings quite low at the moment. But given that, I think as we come into spring, given the fact that selling conditions are pretty strong at the moment, we're seeing clearance rates consistently above average, I think we'll probably see a pretty active spring season this year, and that's going to be a real test of the depth of demand at the marketplace.
I mean, I use all of your data for a lot of my presentations, and there's always that in your chart pack. You've got new listings and total listings, right? And that figure for the 5-year average, it was, during COVID, it was like 20 something plus percent. I think it was like 16% in the most recent one. But it just strikes me that we're never kind of getting above the line. You know what I mean? Like, we're always seeing this perennial problem, and that's the thing that agents always quote to me. I say, oh, how's the stock levels? They say, oh, never enough, right? So it's just this perennial problem. So it seems like we've got what I call a sticky seller's market. So do you think we're entering an era where market mobility is structurally lower?
It is, and you can see that beyond the listing numbers. If you just look at overall turnover, which is simply sales divided by total dwelling stock, it's tracking around about 5%. So that means about 5% of homes are transacting every year. Longer term average, it's more like around 5.5% to 6%. Some markets are seeing turnover in the mid to high fours, like New South Wales. As a good example of that, Victoria is generally showing a fairly low level of turnover as well, coming out of fairly soft conditions, but it's starting to pick up now. So it does look like we're seeing less activity. And part of that, we've talked a bit about just listings being low. That definitely influences overall activity. If there's less stock to transact, then that's going to have a weight, like a weigh down factor on turnover. But it's also things like transactional costs are really expensive. Stamp duty, is a really inefficient tax that tends to limit the amount of activity in the marketplace as well.
Absolutely. It's a real, in terms of mobility of labour, the fact that, you've got, potentially 100,000 or more of stamp duty to pay if you move house, that keeps people where they are, right? They just go, you know what, I'll just travel, and the work from home thing is keeping people, I think, in their houses longer, right? So, yeah.
Yeah, the same thing applies for, say, more mature homeowners who might be looking to be an empty nester or a downsizer. They're just not doing it because they have to pay that additional transactional tax on the other side.
Are we seeing, just talking about the upgraders, downsizers, are we seeing a bit of a mismatch in buyer demand and seller willingness, in terms of the types of buyer and also by city? Is there just run me through that. Is there just a real mismatch in the volume of stock in different cities and in different buyer types?
Yeah, there's some really big differences. And when you look at the market and you sort of divide it into three broad chunks, if you will, you've got subsequent buyers. They tend to be, upgraders, downsizers, movers, people who've owned a property in the market previously and they're transacting as an owner-occupier. Then you've got investors, and then you've got first home buyer owner-occupiers as well. So we're always going to see subsequent buyers as the largest portion of the market. They're roughly at the moment about 41% of demand when you look at just mortgage data, which is a pretty good proxy. Then you've got investors. They're about 37% of demand at the moment, and that's quite elevated. Typically you'd expect to see investors about a third of mortgage demand. So we're still seeing investors a little bit more elevated than what you typically expect to see. And first home buyers at about 22% of demand are quite low. And you can understand why. It's partly because proportionally they're being outsized by investors and subsequent buyers, but also there's affordability challenges in the market that tend to be more acute for first home buyers. But across the states, absolutely, there's some big differences as well. Like in New South Wales, we're seeing investment levels are relatively high, which is kind of surprising to me given how expensive that market is and how low yields are. And, arguably, I'd probably say that the opportunities for capital gains in a market like Sydney, being quite expensive and hard to transact in, are probably lower than other markets. But yet we're seeing about 42% of demand in that market as investors. And the flip side is really low levels of first home buyers because it's so unaffordable. So, and in Victoria, you've only got about 32% of the market are investors. So that's actually not too bad. But, against the national average of 37%, or Queensland, you've got about 40% investors. It highlights that, investors tend to chase capital gain. Yep. And I think a lot of investors have simply viewed Victoria as being a low capital gain opportunity market. But I think that's starting to change now.
We're seeing that absolutely on the ground, Tim, where a lot of our smart long-term investors, even though the yields aren't quite as high, and yes, you do pay a fraction more land tax, it's not over the top, we're seeing very much on the ground sub-markets in Melbourne moving quite quickly. Like, for example, the Bayside suburb of Frankston has jumped pretty much $100,000, I reckon, in the last 6 months. So we're seeing that really happen.
And that's a great area. I mean, absolutely. I think if I was looking for the really affordable markets of Melbourne, I'd definitely be looking around that Frankston market. Frankston, Dandenong has clearly been a strong performer. And it's really got that scarcity of supply. When you compare the same sort of price points with, say, outer Western Melbourne, where there's a lot more land to be developed. I think that Frankston, exactly.
So, Tim, from your perspective, Do you think Australia's in a genuine housing crisis, or do you think this is a failure of planning and policy, and it's a policy crisis?
Well, it's both. I mean, and it's pretty clear it's both. So absolutely, we're not building enough homes for the amount of population growth we have. In the same sense, you can really clearly see there's been bottlenecks and delays and red tape in the planning and approvals process. I'd probably argue that the biggest challenge in getting more supply into the marketplace now isn't that bureaucracy or that approval process. It's actually around feasibility. Construction costs have gone up significantly over the past 5 years. They're not rising as quickly anymore, but they've definitely gone up a lot, and they're not going backwards. And you've got a real tightness of labour markets that's competing with big infrastructure that's not likely to peak in its construction cycle for another couple of years yet. That seems to be the biggest challenge to me, is just, builders aren't going to be active in a marketplace where it's unprofitable. But absolutely, when you look back at the underlying I think fundamentals of the construction sector, there's a whole bunch of things that are holding back supply. There's what I just talked about around just the market factors. There's the bureaucracy of the approval and planning process. And then you've simply got the other side of it, which is productivity challenges in the construction sector are huge. If you look at the productivity report, the Productivity Commission report, it's stating that labour productivity in the construction sector has gone backwards by 12% over 30 years, which is extraordinary. At the same time, the broader economy has seen productivity improvements of about 30%. So it really highlights we need to be a lot more innovative in our construction sector, and great to see things like prefabrication becoming a little bit more mainstream, that type of thing. CBA starting to lend into that space now as well, which I think is a real catalyst for growth.
Exactly. I was just literally reading the Fin Review over breakfast about that today. I don't know if you saw that article, but exactly, seeing more off-site pre-construction or modular construction and prefabbed homes. I think that's going to be a significant point, but a really good point that I read this morning. It's going to reduce the holding cost for developers. That's one of the biggest things in feasibilities for developers, is the interest rate clock is ticking. The minute you start building, you're paying interest. And often what happens, if you've got, to your point, low productivity, if you've got workers and the unions turning up, putting blockades because they want more wages and blowing out what should be a 12-month project to a 2-year project, that can kill the profitability and feasibility of a project. And therefore, developers are less incentivized to keep building. So that's definitely some good points you raised there, Tim.
Yeah, you've also got, just thinking about the weather component, right? If you're building a home in a factory, you don't have the risk of weather delays and that type of thing as well. Sure, there's additional transport costs, and we need to get a lot more scale in the prefab sector, but that'll come over time now that we're seeing it become more mainstream.
Yeah, good point. Tim, talking just about the undersupply issues, what does Cotality data tell us about where the supply shortfalls are most critical? Is there any geographic region and or dwelling type or price point where you're seeing really critical points of supply shortages?
Yeah, absolutely. I mean, this is a widespread issue. It's pretty much every market around the country has experienced this undersupply. But when you look at it in longer terms, there's one market that really stands out for being much more, I think, prolific in housing supply, and that's Victoria. I mean, it kind of flies under the radar a little bit. When you look at like 5-year completions or rolling 5-year cumulative completions, Victoria just stands head and tails above every other market. Part of that's just the nature of the geography there, that you can expand concentrically outwards, whereas in a market like Sydney, there's a lot of waterways and mountain ranges to get across. But if you look at the undersupply across the marketplace, like New South Wales is a really good example of a market that's quite chronically undersupplied, and it's happening in the face of severe affordability challenges. Generally, we're seeing demand side factors slowing down, of course, as overseas migration normalizes, and interstate migration is still deeply negative in New South Wales, like it always has been. But when you look at how many homes are actually being built, there's a clear misalignment between growth in housing demand and the amount of supply we're delivering. It probably does look more acute in the apartment sector. And again, I draw that back to just feasibility challenges. When you look at commencement or approvals, then commencements and completions, it's really clear that there's been a bit of a pickup in approvals, but it's not flowing through to commencements and completions just yet. And I think that's a real reflection of just the hardship of feasibility in the multi-unit sector. That's the sector where we've seen much more significant rises in construction costs. And it's also the sector that's seeing a lot more competition with the big infrastructure projects for the same types of labour and inputs as well. You can look at Southeast Queensland as another really good example of undersupply. Huge amount of population growth coming into that region and not really much of a supply response in the wings. The only markets that really seem to be picking up in terms of supply at the moment is WA and South Australia. And you can see that really clearly in the commencements data. Most of it's detached houses rather than apartments. But yeah, I think that probably highlights that those markets that have seen much more substantial levels of growth in values, they're also markets where the feasibility equation has become a little bit easier as well, because the established market has risen enough to provide builders with some level of a profitability margin.
You raised some really good points there that I'd just like to pick up on. So I'm putting my investor hat on, Tim. I'm an investor. A lot of my clients are investors, and they're kind of listening to this on the podcast going, okay, so where should I put my money? And for me, it's like ticking a lot of boxes. We're recommending our clients look at New South Wales, they look at Victoria, and they look at Southeast Queensland for the very reasons you've said. We're critically undersupplied. And also the point you make about apartments versus houses. Again, looking at your data in those chart packs, and you see the apartment numbers are down something like 35% or 33% below the long-term 10-year average. Is that right? Yeah. That's massive. Whereas the houses are still below, but they're not, they're up 5% below. They're not 30% below.
Yeah, and really interesting when you unpack that data a little bit more and you look at the number of homes that are actually under construction, which means they've been through the approval process, they've had some sort of a commencement, and they're currently in a build phase. For apartments, it's still really elevated. When you look at the number of homes that are under construction, there's roughly about 80,300 unit projects or individual dwellings in the apartment sector that are being built at the moment. But you can look at, and the long-term average, by the way, is about 77,000. So we're seeing an above average level of apartments being built. The reality, though, is a lot of these projects are what you really loosely classify as, zombies. They might have put up the cyclone fencing, done a bit of groundworks, and then suddenly the projects become unfeasible and they're not progressing.
Yeah, exactly. I know exactly what you mean. It's like I talk to a lot of developers, Tim, and they just go, you know what, Rich, we just got this site. We're just going to hang on to it. We'll just have to wait till the market rises or construction costs stabilise. But it's just not feasible because it's well under their 20% ROI. I mean, they can't get funding from a lender if they're going to get less than 20% return. It just doesn't, the risk just doesn't just make sense,
So true.
Tim, I'd like you to imagine, there's a bit of a stretch for you here. Okay, I'm going to imagine that you're now the Minister for Planning. You're the Minister for Housing, right? If you could wave a magic wand and choose 3 things to change in Australia's planning housing policy today to solve this ongoing supply crunch, what would you wave your wand at and what would they be?
Yeah, I mean, there's so many things, and we talked about productivity. I think that's probably one of the major ones I'd be trying to tackle first. There's a lot of low-hanging fruit. We just talked about the fact that there's quite an elevated supply pipeline that's already been through the approvals process and is ready to go. I describe it as low-hanging fruit because it doesn't need to go through that bureaucratic approvals process. It's in the right town plan. It's been approved. It's good to go, but it's unfeasible. So I think tackling the productivity side of things, where hopefully we can start to encourage or incentivize industry to work smarter, not harder. We talked about the prefab and that type of thing. So innovation is really important. Outside of that, I think there's also for say federal and state governments would be just trying to, and local governments, just trying to consolidate that framework. So we've got 3 layers of government that are, involved in delivering housing supply. Most of it happens at the local government area for approvals. I'd really be looking at trying to just condense that down to maybe a state level authority that actually is responsible for the planning and approvals process. It just helps to really streamline the process and overcome some of the localized resistance to housing, which really does seem to be a problem, especially in markets that have really fragmented local government areas. But at WA, for example, you've got an LGA like Cotality. It's the size of a suburb, roughly. It just doesn't make any sense to have a local jurisdiction that's small. And Brisbane's a really good example of a mega council. You've got the Southeast Queensland Regional Plan that sits over the whole Southeast Queensland regional area to provide a footprint and a framework for the building sector. And we're seeing more and more examples of state governments coming in to override local government decisions as well. So I think that's probably another really important factor there.
Okay. Well, when you finish your role at Cotality, mate, I'll be voting for you to be the Minister for Housing, because you've got some great insights. Okay. So honestly, like, you're absolutely right. There is just too many layers of regulation. Like, to your point, there are some things that the different governments have done. Like in New South Wales, you've got the affordable SEP, which allows granny flats. They've also rezoned a number of council areas around Sydney for low to medium LMR, low and medium residential density. So you can build, a couple of townhouses or a small number of apartments on R2 zonings. Now, again, that's great. That's also good. But, I'm looking at one of my own properties to do that at the moment, but I'm just doing a feasibility going, you know what, it's actually really marginal. The build cost is so high that, I might not be able to do it for a couple of years until the market really picks up and makes it viable. So, but you're right, getting those layers, unbelievable layers and layers of regulation to get an approval in place, and that needs to be consolidated. You're absolutely right.
Yeah. And there was one more, because you asked me for three. I think we need two. Okay. So I think the third one, I think the third one would just be the taxation environment, right? Okay. So if you look at how much headworks charges and taxes builders and developers are paying just to get supply into the marketplace, it's extraordinary. Some of the building lobby groups estimate it could be as high as, say, 35-40% of the cost of putting a new dwelling in is going towards those sort of costs and charges. So I think at a time when there's extreme affordability challenges and the government is striving towards this 1.2 million well-located homes target in 5 years, it's probably a good time to consider how do we incentivize or facilitate getting more supply into the marketplace. Surely one way to improve the profitability for builders, private sector needs to make a profit out of this, is to look at that taxation framework as well.
Yeah, really good point, Tim. I mean, I'd written down, you've given me four though, but I'd split productivity, innovation as a separate one, regulations, and now tax. So there you go.
We really appreciate you tuning in to the Property Buyer Podcast, and I hope that you're finding our expert interviews helpful. So that we can keep providing this information and growing our audience, we rely on word-of-mouth recommendations. If you found this information useful, could I please ask you to share this podcast with your friends, family and colleagues, and ask them to subscribe to the Property Buyer Podcast. It would be a big help, and we'd be very grateful for your support. Thanks once again for sharing the links. And now, let's get back to the podcast.
But the other one, on your last point around tax, the government has done some incentives for BTR, build to rent. They have reduced the taxation rate from 30% down to 15%, but that's only going to apply for the big, really large developers, the big institutional players in that space. It's not going to affect the small, medium style or mum and dad type developers at all. But it's a great points there, Tim. If we can move on, I'd love to get your perspectives on pricing. Just a quick, snapshot of where are we at the moment. Maybe you can just give our audience a quick rundown on prices, changes over the last 12 months for each capital city and where we're sitting at the moment.
Sure. At a broad level, we've definitely seen a positive inflection in the marketplace, pretty much aligning with February as the first rate cut happened, another rate cut in May, and now one in August as well. So that's clearly supported this renewed level of broad-based growth in the marketplace. National index is rising at about 0.6% month on month. Definitely not shooting the lights out. I mean, this isn't going, I don't think this is going to be an extraordinarily strong growth cycle given the already high base of prices. But we're definitely seeing almost every market around the country now rising in value once again, including Melbourne, which has been quite weak. Hobart is sort of stabilising to rising. Canberra, which has been quite a weak market, is now showing a trend of growth as well. So the last 12 months, we can see that pretty much every market has seen a rise in values now. So even on that smoothed out annualized growth numbers, we've seen annual growth conditions range from an 8.5% gain in Darwin. Darwin's really showing a pretty solid growth trajectory now after a pretty long track record of weakness. Adelaide and Brisbane and Perth are all up around 7%, 6.5% to 7.3% across those mid-sized capitals, which have generally been outperforming the marketplace, but the momentum's coming out of those markets a little bit. And then you've got markets like Melbourne's up 2.4% over the first 7 months of the year, only 0.5% over the past 12 months. Sydney's up 1.6%. So, yeah, I think I'd characterise the growth rates across Australia at the moment is much more uniform. We're no longer seeing this extreme diversity we're seeing through the last couple of years that was dominated by the mid-sized capitals. So it's much more uniform, and pretty much everywhere is rising. But like I said, I don't think this is, even though we're at the start of what seems to be a growth cycle as rates come down, there's still quite a few headwinds around. Most of it's around affordability, but there's also things like the lending environment's pretty cautious. Regulators are really vigilant around household debt levels and the potential for debt levels to rise as financial conditions ease.
Yeah, really good point. I mean, you're absolutely right. The affordability, the cost of living, that's a big handbrake on price changes and how much people are willing to spend on housing. And people are looking for good alternatives. Also, you know, all of our investors, they're looking for advice on where is going to be the next hotspot, or where am I going to get the best long-term capital growth return? What's your take? I mean, you're sort of saying that we're seeing a normalisation of growth rates across the different capital cities, like Perth and Adelaide have gone gangbusters, and now they're slowing down. I mean, Perth, we had 23% about a year and a half ago. Adelaide did 11 or so percent, but we're now seeing that come down to single digits. But looking ahead, say over the next decade, Tim, what's your thoughts on which Australian cities or regions are best positioned for long-term growth?
Yeah, I'll keep it pretty macro because, I mean, there's always going to be this microcosm of opportunities. But I think probably top of my list would be Melbourne. I think, Melbourne looks quite undervalued to me. We haven't seen the gap between Melbourne's median value and Sydney's this wide since about 1999, to give you some context. The typical buy-in price for Melbourne dwellings is about $800,000. Sydney's at about 1.23, so huge difference. And Melbourne's starting to see some fundamentals returning to the market as well. Interstate migration is pretty much neutral now. I think it'll start going into positive territory. Like you said, there's some disincentives for investors, like higher land taxes and higher stamp duties, but I don't think that's a deal breaker. A lot more investors are paying land tax, but the land tax rates aren't remarkably high compared to other jurisdictions. And then outside of Melbourne, I'd be looking at Southeast Queensland. I think that market, is going to have a fundamentally long-term growth run in terms of population growth. Got the Olympics around the corner, huge amounts of infrastructure that need to be completed by that stage. And there does seem to be a structural change across Australia where more buyers and more people are looking to base themselves in what you'd really loosely describe as lifestyle markets, which Southeast Queensland sort of ticks that box.
Tell me about interstate migration. You'd mentioned it earlier in our discussion, but I often pitch Southeast Queensland, particularly Brisbane, Gold Coast and Sunny Coast, because when you look at the interstate migration flows out of both Victoria and particularly New South Wales, where do they end up? Southeast Queensland. For the very reasons you're saying, it's a sunny lifestyle. I love Brisbane. It's a great city. Every time I go up there, it's just got a great vibe to it. But we're seeing, is that still the case in terms of your numbers? Are you seeing sort of still significant interstate migration moving to Southeast Queensland?
Yeah, absolutely. And it's always a positive state for interstate migration. And it went through an absolute boom in interstate migration through the pandemic, absolute record levels. So it's easing off those record highs. The last 12 months, we've seen about a net flow of about 26,000 net migrants coming across the border into Queensland. That's still higher than what it was pre-pandemic, and it looks like it's probably going to be stabilising around that level. So higher than average, nowhere near what it was through the pandemic. But like you say, Rich, I think there's been this structural change, and more people can base themselves remotely to where they work. If you can be on Sydney money and base yourself in Southeast Queensland, I mean, that's a pretty good recipe, right?
Hey, back in just to that point, if I may interrupt, like it used to be that if you moved to the Gold Coast or Brisbane, you'd have to take a pay cut, right? I'm talking 10 years ago, right? And now with COVID, don't you reckon all of the pays have more normalised now?
I think so. And, as long as you're in that sweet spot of commutability into a major airport and a major capital city, I think you're sitting if you're in a sort of professional white collar environment, generally speaking, you're going to have 2 days back in the office. Seems to be the standard across most employers. So having that flexibility, and we're still seeing a pretty decent price difference as well between markets like Sydney and the Gold Coast, or Sydney and the Sunshine Coast. Nowhere near as affordable as they used to be. Those markets have rocketed in value, but they still show an affordability advantage over Sydney markets, and I think a lot of people are attracted to that.
Yeah, gotcha. Tim, I want to ask you about what your view is on the future demand of apartments versus houses. Like, it seems affordability is going to drive more people to consider apartments, but they may not want them exactly. But are we seeing, like, again, a structural shift in buyer preferences, or do you think that people are still wanting the quarter-acre block and the detached house?
Yeah, I think, despite the fact that we have this affordability challenge in Australia and unit prices are a lot lower than house prices, the gap between the median value is at record highs at the moment. It's about 40% difference between the median value across the capital cities. Sydney's like a 76% difference between the median house value and the median unit value. It's extraordinary. Yet we're still seeing in most cities house values are rising faster than unit values. I think that really demonstrates this preference for detached housing and home with a backyard are still dominating preference trends. Longer term, I think this is going to have to change just through necessity. I think that the fact that unit markets do seem to be so affordable relative to house markets is quite significant. But the first thing I'll say here is I think one of the reasons there's such a big difference at the moment is we're not seeing the sorts of apartments being built that mainstream Australians want to live in.
Yes.
A 3-bedroom apartment does seem to be a little bit of a rarity, particularly in well-located locations. So I think that's what we really need to see preferences changing is more developers catering to mainstream owner-occupied demand rather than, high-rise developments that tend to be dominated by 1 or 2 beds, 2-bedroom apartments and small floor areas. So gradually, I think that will change, and you probably will find that preferences shift just through necessity as well.
Good points. Yeah, I'd love to see more 3-bed plus study apartments and even 4-bed apartments. I know some developers are doing them, but the economics, again, it just comes back to getting the highest yield out of each one.
Yeah, so true.
So, Tim, yesterday we had a rate cut. Finally, Michelle Bullock pulled the trigger, as all the markets were predicting even a month earlier. What's your research saying about the likely course of interest rates over the next 5 to 10 years? Do you think that buyers should brace for the new normal sort of mortgage rate around 5%, or do you think we're going to see ultra low rates at some point in the future?
It's so hard. Let me just disclaim my response here. No one knows what interest rates are going to be 5 years from now.
You've got a crystal ball. You've been doing this. Come on, seriously.
It's going to be data-led, of course. No one would have picked 5 years prior to the pandemic that interest rates would be at zero. Right. So, but let me, with that disqualification or that qualification aside, I think we're probably getting pretty close to what the RBA and most economists would describe as a neutral cash rate, right? It's probably somewhere about 2.9 to 3%, where the cash rate's at a level that it's neither restrictive or stimulatory, right? So we're not quite there yet. I think even the governor yesterday, even though she did avoid the questions a little bit, I think everyone acknowledges the cash rate at 3.6% is still in a restrictive territory. It'll probably get down to, say, 3.1 by early next year, maybe the middle of next year. The RBA thinks it'll be 3.4%. That's their assumptions anyway on their forecasts by the end of the year, and 3.1% by June of next year. Financial markets are a bit more bullish. So I know I'm talking short term here. Longer term, it really depends on what the trajectory is on things like inflation, on GDP growth, on labour markets. Labour markets and inflation are the key factors that the RBA responds to. That's their mandate. But then there's also peripherally what happens with economic growth, what's happening with productivity. If you listen to the media conference with the RBA governor, rate decision, there was a lot of discussion around productivity, and because they've downgraded their assumption for productivity to 0.7% year on year, which is pretty dismal, right? So I think if we start to see productivity improvements, then that opens a door for lower interest rates. But at the moment, with productivity being pretty woeful, it simply means that the potential for, say, wage price blowouts and tight labour markets is going to be with us for some time. I mean, a tight labour market to you and me, Rich, I think is a great thing. But for the RBA, they see, if unemployment holds in that sort of low 4% range, they think that could be a risk for wage price blowouts, and then that obviously fuels inflation.
That's right, yeah. So how sensitive do you think the Australian housing market today is to small interest rate changes compared to previous decades? I remember back in the early 90s, we had interest rates at 17%, but obviously we've got higher debt levels now. But yeah, what's your view on how sensitive the housing market is to small rate changes?
I think it's super sensitive. If you look at debt levels in the household sector, they are quite elevated. So the RBA publishes ratios on household debt to income. So that's currently sitting at about 181, simply meaning that disposable income relative to debt levels, household debt levels are about 181% of disposable income. So that's down a little bit from record highs, but it's definitely elevated. And most of that is housing debt, by the way, about 75% of it. So it does mean that households are definitely more sensitive to changes in the cost of debt. And again, it's something that the Council of Financial Regulators has sort of fired a few shots over the bow, if you will. They've mentioned that if they do see household debt levels becoming more elevated as financial conditions ease, that probably would make them a bit uncomfortable. I think that's just a veiled warning around, if households accrue more debt, maybe that's time for APRA to start bringing in some additional macroprudential or regulatory changes around, firm limits on debt to income ratios or loan to income ratios or something like that. So yeah, to answer your question more specifically, absolutely, households are pretty sensitive to debt because household debt levels are quite high. So small changes in the cash rate and interest rates are going to flow through quite immediately to things like sentiment, borrowing behaviour, credit appetite, and so forth.
I did an analysis of just the median house prices in Sydney, Melbourne, Brisbane over the last 25 years using your data, and found that houses typically returned on average somewhere between 7.5 to 8% per annum capital growth, whereas apartments did around 5 to 5.5%. My question, Tim, is to what extent do you think affordability is going to drag down long-term capital growth? So two things. I think, do you think, this whole debt, excess debt we've got now with bigger mortgages, is that going to bring down long-term capital growth? And secondly, do you think there's going to be more a convergence, like an increase in the capital growth rate of apartments now that they're cheaper, and the growth rate of houses will be slightly slower? What's your thoughts on all of that?
Well, yeah, I think we probably will see a lower rate of overall capital gain. Excuse me.
Yeah.
A lower rate of overall capital gain, partly due to affordability, like you mentioned, Rich, but also, back to our interest rate conversation, we've gone through, 30 or 40 years where interest rates have generally been in a structural decline. And I think we're probably in a position now where that's no longer the case, outside of any sort of black swan events or something like that. So the combination of the fact that interest rates probably can't restructure like they have over the past couple of decades, and affordability is quite stretched, that you shouldn't expect there's going to be, applying like a 30-year average to the next 10 years, might be a little bit optimistic. And then the other point around, say, houses versus units, it really depends. Historically, we've had an apartment sector that's seen significant levels of really bulky supply coming into the market. I mean, just look between 2014 and 2019. We had a construction boom that was characterized by a huge amount of high-rise construction activity. I think what we'll probably see, and that really weighed on price growth, by the way, we're still seeing some of those really high-density markets like, say, Melbourne CBD or Parramatta, some good examples where price growth has really just been nothing, maybe even negative. So I think going forward, there seems to be a lot more focus on infill styles of development for apartments rather than, extreme high density. I think that's probably where there's some stronger opportunities for capital gain. I mean, look at Sydney's metro train station of the Spine going along the metro markets. there's a huge amount of opportunity for infill developments there, which tend to be more medium rise rather than high rise. It's a really good mix of low, middle, and high density. There's a huge amount of amenity, really good transport options. That, to me, probably seems to be like the better opportunity for apartments, and hopefully starts to shine through in some of the capital gain measurements. But at the moment, as you say, the historical analysis really highlights apartments have underperformed massively compared to houses. And the other, I guess, part of that, of course, is that house values have really benefited from the appreciation of land. And the scarcity of well-located land in the major capitals as well.
I think for any investor listening to this podcast out there, it's really important if you are buying apartments. And look, we generally buy houses for our clients, but we do buy apartments. And apartments still represent good value because we can buy apartments at below replacement cost now. Because construction costs have gone up so high, if you look at the land content sometimes in an apartment, sometimes it's almost 95% of what you're paying. So, it's not that we should be turning our nose up or thinking you're buying an inferior style of investment, buying an apartment, Tim. It's going to be very much on par. It's just that historically houses have outperformed apartments, right? So, Tim, I just want to ask you about the proportion of renters that are going to make up the property market. Typically, we've seen on ABS data that it's a third of people own their homes outright, a third have a mortgage, and a third are renting. With this whole housing crisis affordability issue, what do you think those proportions are going to look like over the next 2 decades?
I think they probably will shift, to be honest. Again, we've talked a lot about affordability, Rich, and when it takes a lot of savings to save for, say, a 10 or a 20% deposit against the marketplace, when serviceability is quite challenging, especially coming after a cost of living crisis, then you're generally going to find home ownership levels are going to be reducing, which of course means either more people are renting or younger folks staying at home with mum and dad for longer. We're definitely seeing some, at least anecdotal evidence of more multi-generational households forming. And if you looked at the Statement of Monetary Policy that came out recently, the RBA is also reporting this ongoing rise in the average household size. After it plummeted through the pandemic, it's now pretty much back to pre-pandemic levels as well as group households reform. So yeah, I think to answer your question, I think, say 5 years from now, we probably will have a slightly higher proportion of renters in the marketplace, simply a reflection of affordability and the challenges of getting your foot in the door of housing markets.
Yeah, good point. I agree. Tim, you look at data every day, right? You're a data nut. What trend or data point do you think is often overlooked or most overlooked by property buyers and investors at the moment?
Yeah, I think the market is heavily analysed, so it's hard to think of any data points that aren't under some level of focus or scrutiny. The yield is probably a stat that's not overlooked, but probably has less significance than the capital gain numbers, and probably for obvious reasons. I think most Aussie investors are very focused on opportunities for capital gain. The yields, apart from providing an indication of opportunities for cash flow or helping with serviceability, the yield's also a really good indicator of the balance between housing values and rental rates as well, right? So a market like Darwin, even though Darwin has its own risks, it's quite a small and volatile market. I mean, the yield in Darwin is, on a gross yield, is up around 6%. It's extraordinary. It's one of the few markets where you probably have an opportunity for a positive cash flow from the outset. The yield in Sydney is very low, but it always has been. So I think yield should have a slightly higher spot on the investors' radar. Not that investors, I think, are going to be focused on cash flow unless we see some structural changes in taxation reform or something like that makes negative gearing harder, and that's probably a different conversation. Outside of that, I think the listing numbers are also really important. We talked about it at the very beginning of the podcast, Rich, and they're really, this is an immediate set of data, so there's no real time lag. It can go quite granular. Listing numbers give you an idea or an understanding of immediate supply in the marketplace. And the fact that we're seeing this, as we talked about, this record low level of stock in the marketplace, I think is indicative of a much more important measure of supply, at least for the immediate outlook for housing markets, rather than newly built supply, which is where a lot of the supply conversation tends to revolve.
Excellent points. Tim, I don't know if you'll be able to answer this one, but how is Cotality adapting to better measure hidden market forces, things like of the volume of off-market listings or intergeneral wealth transfers or investor hesitation? Are those sort of measures that you are ever able to look at?
No, these are like the holy grail of some ways in understanding data. Yeah. I think inherently some things are just going to be invisible, like trying to measure intergenerational wealth transfer. Maybe the banking sector could be measuring that, but for us, it's much more inferred. So like we talked about Sydney earlier on and how unaffordable that market is. The fact that prices are still rising as they are in Sydney, I think is a bit of a hint that there is some level of wealth transfer and, we're seeing first home buyers or younger buyers getting a bit of a leg up from their mum and dads or relatives who have built up equity in the marketplace. But beyond that, it's something that's really hard to measure. Same with off-market listings. You can go through exercises where you try to match home sales with listing campaigns. But the reality is it's not perfect. A lot of homes are advertised with vanity addresses, for example, or without a full street address, and it's just impossible to match record for record. So there's always going to be a little bit of grey space. But I think it's fair to say, again, just looking inferentially or anecdotally, there are more properties that are selling without a marketing campaign behind them. And I think that just reflects the tightness of the marketplace and the strong sellers environment.
Yeah. I mean, we get a lot of even vendors coming to us directly going, do you have a buyer on your books for a property? And, occasionally we're able to match up someone. So again, there's no selling agent involved. There's just a buying agent involved because it saves the vendor paying sales commission and all the rest of it. And then we also do a stack of transactions direct with selling agents off market. So all of those aren't getting captured necessarily in the listing numbers as we talk about. Tim, I want to move on to AI. This is probably a favourite new topic of yours, but how do you see AI and data analytics changing the way buyers and professionals make property decisions over the next 5 years?
Yeah, I mean, this is nothing new to analytics. AI has been around for quite a long time in the form of things like machine learning, for example, but definitely it's becoming much more mainstream now. So when we look at some of the applications for AI, I mean, there's a really obvious ones of using AI to, improve attribute coverage in housing data. For example, using AI to analyze aerial photography or satellite imagery to infer what's the house made out of, what's the roofing material, what's the penetration of solar, what homes have swimming pools, what's the green space coverage, all that sort of stuff. That's becoming really common through AI use cases. Looking at, we've got this great partnership with CSIRO called Rapid Rate, where we basically feed all this data into the CSIRO and they're using AI models to understand what the energy efficiency is of homes. Is another really cool example. But I think going forward, you will find that AI becomes more and more mainstream. It's going to be feeding the underlying quality of the data, but also the level of detail. We can actually look at housing trends as well. And then you've got the less direct examples where, even just use cases where we're trying to understand what are the first home buyer incentives from state to state. You wouldn't imagine how complex this is of a project to do because there's so many changes and so many differences from state to state. Using something like Copilot to start, do 90% of that analysis and accrue all the data together and then take it through a proofing and a review process is really time saving as well. So I think there's going to be a huge amount of changes and productivity improvements that we see from AI. Absolutely, this is something that's coming. I definitely wouldn't be standing in front of the steamroller. It's coming and it's coming fast. And we've actually got to embrace AI and otherwise you get left behind.
I'm sure you're using it every day. Talking of that as first home buyer thing being complex, we just did a report recently on land tax. We've just released a report on a guide to land tax because the land tax thresholds are different for every state and also for different property types and which you own the property in, whether it's in personal name, in a trust or company. So we just put together a 50-page report to cover that very point. Tim, I've got a couple more questions for you just to wrap up, but what surprised you most about the property market in the last 12 months? And also looking ahead, what blind spot do you think we should be watching out for in 2026?
Okay. Surprises. I think the resilience of some markets that are very expensive. Sydney is probably the most obvious one. How values are continuing to rise in a market like Sydney, where you're looking at a dwelling value to income ratio that's about 10 times. if you're on the median household income and you're buying the median price dwelling in Sydney, and even if you have a 20% deposit, in theory, you'd be dedicating nearly 60% of your pre-tax income to service a mortgage. Yeah. So obviously banks aren't going to lend on those sort of numbers. And maybe it goes back to the intergenerational wealth transfer thing we're talking about.
The bank of mum and dad is well and truly alive, I tell you, you know?
Yeah, absolutely. But when you look at the strength in some of those really expensive markets, it has really switched to the more affordable markets as well, where I think we're seeing a lot more mainstream demand flowing into lower quartile priced markets. And that's simply where people can obtain credit. Yeah. So that's maybe the biggest surprise, is the resilience of the market at a time when we've been through a cost of living crisis and when interest rates have been way above average. Yet we've seen housing markets still performing quite strongly, albeit with some diversity. And I think that just reflects the undersupply of housing and the resilience of demand. And you could also look at mortgage arrears, that they seem to have peaked at about 1.6%. At a time like we've just been through this hardship as a nation. We've seen Australian borrowers staying on top of their mortgage repayments almost across the board.
Delinquencies are very low.
I think the resilience of the market. Yeah, absolutely. I mean, that's a testament to the lending swim between the flags, as they say, for prudential standards. Yeah. But maybe it's also a reflection that our lending standards could be a little bit looser. Having a slightly higher arrears rate probably wouldn't have been devastating, but it probably would have meant that we have more people being able to access credit as well.
Yeah, fantastic. Really good points, Tim. Tim, if you had $1.5 million to invest right now, where in Australia would you buy and why?
Yeah, so we kind of covered that in the hotspots. I think top of my list at the moment for investment opportunities would be Melbourne. And if I was to be a little bit more specific, I think Melbourne's got some good opportunities around. 1.5 million isn't going to get you into a Toorak or a Brighton or something like that, but they're the sort of markets I think that have a real blue chip appeal to them, and they've generally been quite weak. I mean, Melbourne's top end market has really led the weakness. At least over the past couple of years. So try to buy really strategically in Melbourne within that sort of 10K ring, detached home with a block of land as far as that 1.5 million can get you, I think would be a good idea. Even again, the apartment market in Melbourne, I wouldn't be touching anything in the high-rise CBD markets or anything like that. But if some of your sort of inner city fringe markets, well-established stock that's the old six-pack analogy, I think is a really good value as well. Outside of that, Southeast Queensland, I think in Southeast Queensland, again, I'd be trying to buy within that 10K ring of the city. I mean, scarcity is just so important for supply. Some of those coastal markets as well, buying close to the water and good commutability back to the city and the airports, I think was always a good recipe for long-term capital gains.
Fantastic. And Tim, last question. What's the best piece of investment advice you've ever heard or received yourself?
Yeah, I think when it comes to property markets, I think the analogy that always sits with me is it's timing the market rather than timing the market. I mean, trying to time the market is just notoriously hard. Even for somebody like me that's looking at the data all the time, there's always surprises. And I think just it's a bit of a mug's game, and it's more luck than anything. If you can really time the bottom of the cycle, sure, you can probably get it about right. Like clearly we're in a bit of an upswing at the moment. We come through a bit of a weak patch, but it's timing the market that really tends to drive your success. The other thing would simply be scarcity drives growth. Markets that are inherently scarce and in high demand are always going to outperform, even though they might be more expensive. You tend to find that the capital gain opportunities tend to be more significant.
I love that. That's my quote of the day. Scarcity drives growth. Anyone listening to that, write that down. That's perfect. Tim Lawless, an absolute treasure. Thank you so much for sharing your time with the Property Buyer audience today. Want to wish you very well for the rest of the year, and thank you again for all the work you do in bringing us analysis in the market. So again, Tim, thanks so much for being with us today.
Absolute pleasure, Rich.
Thanks for being with us on another Property Buyer podcast. If you have a question you'd like to ask, please click on the SpeakPipe link and we'll answer this during the next episode. If you're looking to buy a residential or commercial property in the near future and would like to get the added advantage of having a buyer's advocate on your side, then please reach out to my team today and send us your inquiry, and we'd be delighted to help. please visit our website at propertybuyer.com.au, where you can stay updated with all my latest market updates, weekly blogs, and live suburb profiles to help you make better property decisions. We look forward to connecting with you again on the next Property Buyer Podcast.